Hi there, I'm Ren Agarwal and I'm back with another NFO review, this time from the HDFC Mutual Fund, and the fund is called the HDFC Developed World Indexes Fund of Funds. This fund essentially tracks the MSCI World Index, and essentially it does this through a suite of funds from Credit Suisse basically. So what it essentially does is that it invests into 4 or 5 funds of Credit Suisse. These funds are domiciled in Ireland and Luxembourg, and each ETF or index fund basically represents a particular market. Now, the HDFC FOF will essentially mimic the MSCI World Index through these particular funds. The MSCI World Index is a dominant index which spreads across various geographies. It's across 5 continents, 23 countries, a whole lot of stocks. In fact, it's about 1,500 stocks in this particular index. And of course, US has a very dominant place in this index with 67% of allocation being to US markets, followed by allocation to European and Japanese markets as well. In terms of sectors, when one looks at the current holding, it is skewed towards the IT sector, towards financials, towards healthcare, consumer discretionary and industrials, and with a huge exposure to the US markets and to the IT sector. It is no surprise that the main holdings are Apple, Alphabet, Microsoft, Amazon, Facebook, etc. Of course, the fund also holds many good stocks from European markets like Abbott Laboratories and many other such stocks. So one of the reasons that this fund is also being launched according to HDFC is because it has very low correlation to the Indian markets. The correlation is about 0.4% between Nifty 50 and the MSCI World Index. And when one also looks at the returns between Nifty and MSCI, of course, differ in a big way. But the main reason for this fund is to provide you geographical diversification among international markets and the fact that there is a very low amount of correlation. So should you invest? Well, certainly the fund is well poised to capture the growth in the overseas markets. You know, when one looks at the international funds that are available in India, they seem to be skewed to a particular country or to a particular theme. So, I've been seeing funds around countries, of course, US funds or NASDAQ related funds, or they have been around various themes on technology, considering that technology stocks have done really well. They've been concentrated in various themes. And of course, this fund is very well diversified with 1,500 stocks. In fact, I would say a little too diversified. Now, NFOs come with their own set of problems. The first being the expense ratio. Remember that this being a FOF, there are 2 expense ratios. One is the expense ratio of the ETFs or the index funds in which this FOF is investing in. And then the FOF has its own expense ratio. So from what I understand, the ETF expense ratio is about 0.65%. And as per SEBI rules, the FOF in India can have an expense ratio of about 1%. So we can expect the overall expense ratio to be anywhere between 1 to 2% in this particular fund. Now, being an NFO, we also do not know what is the tracking error. And I just want to refresh your memory to tell you that tracking error happens because of costs, because of taxes, because of timing differences. So essentially, the fund has to deploy this money into these indices. And there's going to be a difference in the returns between what these index funds are giving you and what the FOF is giving you. And that is known as the tracking error. And this tracking error will be known only once the fund has got at least 6 months to 1 year of performance. So in terms of the expense ratio and the tracking error, how well the fund is able to optimally invest the monies that they have received remains to be seen. Of course, taxation in international funds is debt taxation and not equity taxation. So you also need to remember that. My take, well, you decide investing into this fund based on 2 things. what is the diversification that you currently have and the diversification that you want to have. If you already are invested in US markets through S&P or even through the NASDAQ or even through actively managed funds, then this fund may not work for you, because if you look at the returns and if you look at the correlation between the S&P 500 and this index, it is highly correlated to the extent of 90%. The returns between S&P 500 and the MSCI World Index have also been very, very similar. So if you already have an investment into US markets through various other funds, then you probably can give this fund a miss. But if you have never invested in international markets and you want to start investing in international markets, I think this is a good fund to start investing into, because it's going to give you very good diversification. It's going to give you also risk diversification from US markets, because remember, while US markets might be doing great over the last decade and the stocks have also done really well, from a risk management perspective, you do need to diversify, and this fund gives you a very good country diversification among developed markets. I would say this fund is perfect for investors who do not have exposure to international markets and who are looking at a conservative, low-cost investment. They can certainly invest into this fund. For others who already have exposure to US markets, invest only if you feel that you want to have more diversification. Make sure you click on the bell icon to subscribe. We do look forward to your feedback. Till then, bye-bye.